This week might be the most important week of the year for anyone watching memory stocks and AI infrastructure. We've got Micron and SanDisk fresh off a brutal pullback, SK Hynix about to make Wall Street history, and Samsung just dropped a quarter that beats Apple and Nvidia combined. Let's break down all four and why they're all really the same trade. Not financial advice, just walking through the data. Here's the setup in one sentence. AI servers need a type of memory called HBM, high bandwidth memory, and there simply isn't enough of it. That shortage is turning memory chips, historically one of the most boring, cyclical, low-margin businesses in tech, into the hottest trade of 2026. Start with Micron. The stock hit $1 trillion in market cap back in May. It's up around 250% year to date, and analysts see fiscal year net profit surging almost 900% to around $83 billion. But it's also down about 22% from its late June all-time high. And Michael Burry, the investor who called the 2008 housing crash, has reportedly opened a short position, essentially betting the entire AI memory story is overextended. My scanner actually caught this. Micron just flipped to a weekly bear signal, right at the highs, with implied volatility sitting above 100%. That's the options market pricing in a real fight between the bulls and Burry. Next, SanDisk. This one is almost unbelievable. It spun off from Western Digital at around $38 a share early last year. It's now trading near $1,700. That's a run of over 4,000%, and it's showing the exact same pattern as Micron. A weekly bear signal on the same day, a strong bearish divergence on my fear and greed scan, and options pricing in 136% implied volatility. That is not a coincidence. That's the whole memory sector cooling off together after a historic run. And yet, Goldman Sachs just raised their target to 2,200 and Bernstein raised theirs to 3,000. So the smart money still likes the story, they just think the stock got ahead of itself short term. Now here's the one most traders aren't watching closely enough. SK Hynix, the #2 memory maker in the world, is about to list on the NASDAQ this Friday, July 10th. They're raising roughly $29 billion. If that holds, it would be the largest first-time US stock sale by a foreign company ever, bigger than Alibaba, bigger than Saudi Aramco. SK Hynix controls about 60% of the entire high bandwidth memory market. They actually just passed Samsung to become Korea's most valuable public company for the first time in 25 years. Here's the part almost nobody is talking about. The company isn't changing anything about its business with this listing. Its factories, its margins, its order book, none of that changes. What changes is simply who can buy the stock. American investors get direct access for the first time, and that alone tends to unlock real value. And finally, Samsung. They just dropped preliminary second quarter numbers, and the number is almost hard to believe. Operating profit is guided at roughly 89 trillion won. That's about 18 times higher than a year ago. It's being called a bigger quarterly profit than Apple or Nvidia posted in the same period for any tech company ever. The driver is simple. DRAM and NAND prices jumped 40 to 65% in a single quarter. Samsung is even pushing for another 20% price hike for the third quarter. But there's a catch worth knowing. Samsung makes phones too, and the same price spike that's making their chip division rich is actually squeezing their phone division so hard they've warned it could post its first ever annual loss. So zoom out. Micron and SanDisk just cooled off after historic runs. SK Hynix is about to get a massive valuation unlock from a US listing, and Samsung just proved the entire memory pricing cycle is real, not hype. The thing to watch this week is how Micron and SanDisk react once SK Hynix actually starts trading Friday, and whether Samsung's full July 23rd earnings call confirms HBM4 progress against Nvidia's next generation platform. I will be watching the tape and looking to buy the dip on the DRAM ETF. Thank you for watching. If you found this video interesting or helpful, please like and subscribe for more chart breakdowns and stock deep dives. Remember, this is not financial advice. Please do your own research and manage your own risk. See you on the next one.